Palantir Technologies, a data mining company, went public September 30th in a direct listing that values the company at $21 billion. I see two reasons not to buy this stock. Palantir, founded in 2003 with capital from investors including the CIA, provides software to help organizations analyze data. For example, Palantir provides tools that help Immigration and Customs Enforcement (ICE) conduct deportation raids. These tools include Falcon, which enhances data accessible to ICE investigators involving the illegal movement of people into, within, and out of the United States, AP reported. Palantir used a direct listing, in which a so-called reference price is set, to enable current shareholders to sell their shares. The stock closed its first day of trading at $9.50 a share, below its $10 opening price, but above the range at which the shares traded in private hands in August, $7.31, and September, $9.17, according to the Wall Street Journal. Palantir's financial results show big losses and modest, though promised increases, in revenue growth. Since its founding, Palantir has lost money every year, posting net losses of about $580 million in 2018 and 2019. Its 2019 revenues grew 25% to about $743 million. The good news: last month Palantir said it expects 41% revenue growth to $1.05 billion for 2020, according to the New York Times NYT. Palantir is worth a bit more than it was in 2015, when investors valued the company at $20 billion. Still, its $21 billion valuation is a bit below the $22 billion valuation that bankers were floating before the direct listing, according to Silicon Valley Business Journal. Palantir's cash ImmolationPalantir is a cash furnace. For example, in 2019 its operations consumed $165 million in cash, which represented 22% of its revenue. Its cash burn increased from the year before. In 2018, Palantir's negative cash flow from operations was $39 million. Its 2019 cash burn soared a whopping 323% while its revenues rose 25%, according to its prospectus. Palantir's product is very expensive to sell and the company has very high overhead costs, accounting for a combined 105% of revenue last year. For 2019, for example, Palantir's sales and marketing expenses of $450 million represented 61% of its revenue, while general and administrative costs, of $321 million, were another 44% of revenue. After 17 years, Palantir has not figured out how to make a profit. Will its executive team learn how to do that now that its shares are publicly traded? Palantir's investor-unfriendly governance structure to invest in Palantir shares is to be happy that its three co-founders, investor Peter Thiel, CEO Alex Karp and President Stephen Cohen, could gain more control as they sell their shares. The journal noted that Palantir has one of the most aggressive governance structures ever seen. As the journal reported, through a unique feature of the voting structure, Mr.